Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the Argonaut Absolute Return Fund, and we're here for our May update. Barry, it was another rollercoaster month for markets. How did the fund perform, and what were the main drivers of performance?
Well, it was another good month for the fund. The fund delivered plus 4%, and that was against the peer group, which was largely either flat or negative. We were negatively correlated to the market, despite having twice as many longs and shorts in capital terms. Our best contributors were on the short side. US online car platform Carvana halved for the second month in a row, and Adler, the German property company, nearly achieved the same feat. Another good performer in the short book was US salad bar company Sweetgreen, which delivered another unhealthy monthly return for its investors. And then on the long side, we were helped by Norwegian E&P company Okia, which was up 50% in the month, and also tanker company TK, which rose 28%.
Quite a few companies, including Microsoft, Tesla, Snap, Lyft, Coinbase, have recently announced hiring freezes. Are you worried that there is a recession ahead in the US?
So I think we need to differentiate two things. One is what's going on in the tech sector and the rest of the economy. And then secondly, the difference between a nominal and a real recession. So firstly, all of those companies are obviously in the tech sector. It's the tech sector that is going into recession. And the reason for that is largely supply related, in that it's due to the capital cycle. So if over the last 10 years, most public and private investors have allocated nearly all of their capital to technology and think it's the one sector that they all need to be in and the only sector they need to look at, then a lot of very mediocre companies get funded. And those companies have overexpanded, and they're finding that either the demand is not there or there's too much competition. So they're now having to shed labor because they're the ones that are seeing the downturn. And I think that's obviously coincided with the Federal Reserve belatedly withdrawing the punch bowl from the party after it was already in full swing, and the bans still need to be paid. And by that, I mean that a lot of these businesses didn't focus on profits. They solely expanded their top line, and therefore they were utterly dependent on the market to fund them. And now with the punch bowl taken away, the piper has to be paid in terms of making a profit to fund their own growth. And that's why I think we're going to see a spate of bankruptcies in the tech sector and the innovative growth sector. And these are the weakest link that will be taken down by the Fed hiking cycle. Then I think we also need to think about the real recession and a nominal recession. So I think a lot of people in the market at the moment have only experienced deflationary busts, where essentially economic growth slows down and inflation goes negative. I think that's not what we're going to experience this time around. And the reason for that is inflation is high, again, because of the capital cycle. So companies in the commodity sector, for example, have been told not to invest because they're sunset industries. And they've had low commodity prices for quite a long period of time. There's a lack of supply, but demand is incredibly firm, particularly as the global economy deglobalizes, with Russia being cut out of Western supply chains, and also, of course, with the energy transition. So there's great demand for commodities at the moment, and there's not very much supply. So that will, in fact, keep commodity prices high, even though real economic growth is slowing. And so the cure, if you like, to inflation is actually to let the capital cycle come full circle, and for there to be a boom in commodity prices where those companies eventually manage to invest in new supply. So I think what we're seeing at the moment is the revenge of the old economy. And of course, because most people in the financial markets still think that inflation is going to go away, still think that it's just uh, uh, just abnormal that tech's not performing and don't really understand that the capital cycle has decisively turned towards value stocks, this revenge of the old economy is a dish that is being served up cold. Now, let's also look at the difference between a nominal and a real recession. So as we've said, most people have only experienced deflationary busts, but the problem is that the Fed can control aggregate demand, but they can't control supply. So Fed tightening will cause the real economy in terms of economic growth, the difference between the economic growth rate and inflation to probably go negative. Well, that doesn't mean to say that nominal economic growth will go negative, because if inflation stays high because of supply side factors, then nominal growth will still be okay. And of course, most people operate in a nominal world where they look at their wages, house prices, share prices, and maybe only a few people look at that relative to inflation. And corporate profits are also, of course, nominal. So if corporate profits don't go into recession, then probably unemployment outside of tech won't go up much. So I think what's going to happen is that as the Fed hikes, the pain of that is going to be taken in the tech sector, in Wall Street, but Main Street will probably be okay because Main Street operates in this nominal world. And as we've pointed out before, the template here is the 1970s, where in 1974 we saw a real recession in the US and the UK, but nominal growth never dipped below 8%. And I think something similar is happening now. And this is what investors, I think, need to pay attention to.
Out of all the commodity sectors, you're currently very bullish on energy. Why is this?
So I think, look, on the demand side, cheap and reliable energy remains the biggest bottleneck to global growth. And I think a lot of people underestimate the intermittency problems of wind and the problems with storing alternative energy in any scalable or affordable way. And frankly, it's going to take a lot of time before that hits those people between the eyes that fossil fuels are here to stay and they cannot be replaced as a source of cheap and reliable energy. But on the supply side, there's been so little investment in commodities over the last decade. That's partly due to low commodity prices. It's partly due to ESG constraining investment, but it's also now due to the fact that we previously thought, oh, we'll just outsource fossil fuels to the Russians or to OPEC. And then we've realized what a mistake that's been in terms of energy security and geopolitical power. So energy is going to be the best performing sector over the next decade as the market slowly comprehends all of these issues and that we need a boom in energy, and particularly an investment in energy to solve the global supply bottleneck. So at the moment, throughout the energy complex, we're seeing really amazing opportunities. So at the moment, not many people realize that it's oil refiners rather than oil producers that are actually recording record profit margins. Those record profit margins won't last because refiners will then try and refine as much crude as possible. They'll stay high, but volumes will increase. And that's really good for crude demand. What's also good for crude demand is China reopening. And of course, air travel getting back to more normalized levels. So we'd be very surprised if crude didn't hit at least $150 this summer, and it may in fact go a lot higher. Now, when it reaches those levels, people will obviously worry about demand destruction. But I think what those people don't get is people are already buying refined products, which is, you know, you and I don't buy a barrel of crude oil. We buy a refined product like diesel at the pumps. And because the supernormal profits at the moment are being made by the refiners, actually the equivalent price of diesel at the moment is already above $200, and yet we're not seeing any demand destruction. So what will happen is crude will go up, refining margins will go down, but it won't. If we were going to see demand destruction from $200 oil, we will have seen it already. Now, the other opportunities are obviously if Europe isn't going to import or try to wean itself off importing Russian oil and gas, it's got to get that oil from somewhere else, and it will probably try to get the oil from OPEC, and that will involve more ton mileage because obviously the journeys by ship are a lot longer. That's really great for energy shipping, and it will probably try and get gas from North America, where Henry Hub remains the cheapest source of energy in the world. And the best thing about shale and fracking is that it's short cycle, and production can be ramped up fairly quickly. But also the only problem is, of course, that there is an absence of rigs, an absence of people, absence of sand and water to really ramp up production, because again, the oil services industry has been in a bit of a recession for quite a long period of time, and people have been reluctant to invest. But nevertheless, getting that Henry Hub gas, which has more than doubled in price this year already, but is still at less than $50 a barrel equivalent in crude, getting that from North America to Europe will be a fantastic challenge, but a great growth opportunity over the next few years for companies involved in that. So in sum, fossil fuels are going to be the place to be, and we think, certainly over the next few months, the risks on the oil price is certainly a lot higher than lower.
How do you protect the fund against short squeezes?
Well, look, I think short squeezes can be mitigated, but they can't be avoided completely. So what causes a tradable rally in trash is central banks pivoting to dovish policies. So if central banks inject a lot of money into the real economy or the financial economy, then that causes a tradable short squeeze. So in terms of how we manage the portfolio, if that were to happen, we would cut our position sizes and the overall size of our short book. But in general, the way we control short squeezes is to be, one, diversified, but two, have smaller position sizes. So it's pretty rare for us to have a short position in any one stock, which is more than 3% of the fund. And that really helps us not be squeezed into closing things out at inappropriate times. But I would say overall, of course, we've, if you like, had great short alpha through a bull market. So our shorts have outperformed the market by more than 150% over the last 10 years. And actually, that bull market has been obviously sponsored by the cheap money of central banks. So now that that cheap money has been taken away and probably won't be reintroduced for some time, shorting has in general become a lot easier. But I still wouldn't recommend shorting for DIY investors. It's obviously a lot more complicated than traditional investing, and risk controls are very important. And there are factors to consider, such as the cost of stock borrowing financing as well.
What would you say the fund offers investors, which most other equity funds do not?
Well, look, we've been saying since last October that we're heading for a 1970s stagflation redux. I see the World Bank has come out today, 9 months afterwards, and basically warning of the same thing. Welcome to the party. We're obviously delivering at the moment returns on our long and our short book. Now, it's not obviously guaranteed that we'll continue to do that in the future, but we've had 9 months in a row now of positive returns on the fund, and that compares obviously to the market, which has largely been negative, and growth funds which have blown up. I think The other thing to consider is that I think there's now a general consensus that this rally in value stocks and underperformance of growth stocks is some kind of aberration. And as soon as inflation goes away, which a lot of people think is going to be easy, then we'll be back in the same old market where growth stocks are outperforming value stocks and there won't be any inflation. I have to say, I think that's a very naive assumption that most people are making at the moment in markets. And that comes from most people just either experiencing only one amazing cycle where growth outperformed by a record amount over the last 12 years, but also people that should know better forgetting about the capital cycle. And I think one of the problems with the capital cycle is, unlike the elephant, the market always forgets.
Great, thanks very much, Barry.
Thank you, Chloe.